Should you worry about stock market crashes? Well, first off, we always bounce back. And I know that's not a great argument, but we do. We have always bounced back. Historically, we have bounced back from crashes. And that's a good thing to know. The American economy is resilient and has been resilient many, many times. The stock market has never gone to zero because, like I said in yesterday's video, do you expect that all companies that are large and profitable and do all the things that they do that are so integral to our lives are just going to go bankrupt all at once? No. So the stock market doesn't go to zero. And then if you just looked at the S&P 500 chart, if you just looked at the price of the S&P 500 over time, it looks like this. It looks exponential. It's an exponential curve that goes up. It goes up, it goes up, it goes up over time. You draw a trend line through it, the crashes go away. Because like I said, the crashes are overreactions to speculation or economic events or catastrophic. And that's not to say those things aren't real and that those things didn't need some type of response by the markets, because they definitely do, because there's a reason why the prices fell. But there are overreactions. It's not just a reaction, it is an overreaction. And then let's not forget that in the indexes, when certain companies fall by the wayside or go bankrupt, they are replaced by other companies that are of value and that are meeting the criterion of the indexes. And so that does happen, and it allows the indexes to grow forward over time. And then let's not forget that our game is not the short term. Our game is long-term investing. Our game is investing for the long term. I've told you before, if you can't invest for over 5 years, you shouldn't be investing because the likelihood of the stock market dropping and staying down over a 5-year period is greater than any time period longer than that. So if you can't invest for at least 5 years, then you probably don't need to be putting that money in the market itself. So if long-term investing is the game, then we don't care about short-term crashes. We don't care about the market dropping hard over a few days or a few weeks or a few months, whatever it may be. We don't care as much about that. Yeah, does it stink to see your account values drop and drop and drop? Sure, but guess what you're doing that whole time, or should be doing that whole time, is buying, consistently buying, putting money in your 401k, putting money in your IRAs, doing all of those things that you're supposed to be doing systematically as a part of the financial action plan. You should be doing those, and they will be profitable to you over time because you are buying at cheaper prices. Therefore, you will make better returns in the long term. You're not just losing all of this money. You're actually putting more money to work. And then you can make the decision as well to put more money to work on your own, as I was talking about earlier. And let's not forget that you don't actually lose money until you sell. I mean, everything else is just based on market value of stocks and market value of indexes over time. But until you actually sell, you didn't lose anything. You didn't realize any loss. And so if you sell, then it gets real. But if you hold on over time, you ride the roller coaster over time, then you will be fine. Things will turn out well. They have historically turned out well. And the truth of the matter is you just don't know who you are as an investor until a crash. For instance, the coronavirus pandemic was the first crash that I have dealt with as an investor. I was alive for a couple of the other ones, but I didn't have money in the market at those times. I was a child, and so I didn't have money in the markets. But now that I do, and I see the crash happen, there's 3 things that you can do, and I saw people do all 3. And one of them is completely wrong, and the other 2 should be where you lean heavily. And so you can really do 3 things in a crash. You can either sell, which is wrong. You should not be selling during a crash unless you absolutely have to maintain and pay your bills and live your life because you lost a job, or any number of bad things that happen economically because you're seeing the crash. The crash is for some reason, and it may be an economic one that got a hold of you and your household. So that's the only time you should. Otherwise, you shouldn't be selling your investments. Then the other one is you should hold them and ride it out. And this is a perfectly fine thing to do, especially with individuals who aren't super sold on the market already and don't understand and do the research as much. Sitting and holding is perfectly fine. Perfectly fine. Just ride it out, allow yourself to do so. And then there's individuals who buy. And to be honest, if you're putting money into an employer plan, you are buying. but you're not making the natural decision to go buy more. Because you can make that decision to do that. And so those are the only three things you can do, but you have to at least be holding on and riding it out. And hopefully you invest more. You have the wherewithal to do so. And then these crashes, they just let you know if you can actually put your money where your mouth is when it comes to your long-term viewpoint. Because if you say you're a long-term investor, a crash will reveal that. A crash will reveal if you really are a long-term buy and hold type investor, or if you just want to make a quick buck. Because if you want to make a quick buck, the stock market's not a great place to be if you are trying to be a long-term investor. Long-term investing happens over the long term. You compound your money over time. You don't. You may make short-term profits that are very nice, but you're not selling them. You just continue to buy and buy systematically over time. And the sad part is a lot of people miss out on returns by either selling or failing to get back in at any particular time because they're trying to time things. They're trying to get out at a perfect time and get in at a perfect time. And let me tell you, I don't know if I've ever seen somebody do it correctly. And if they have done it correctly, then bravo, that's awesome. But to see an individual do it correctly, most times it's individuals will do it and they will sell when it's low and end up getting back in when it's high. And that's the total opposite of what you want to do. You want to be buying low and selling high, not buying high and selling low. And then just remember that crashes give you opportunities. They give you opportunities to put more money to work. They give you opportunities to keep a level head, prove that you're a long-term investor, and put money in at low prices and get deals that other people can't get. It's funny that if we'll go to a store and see a shirt that we like that's 25% off and we have to buy it. Well, why don't we look at stocks the same way? Why don't we look at indexes the same way? If they're 25% off of what they were worth previously or 30% off what they were worth previously, then why shouldn't I buy it? Isn't it, aren't they still the same companies? Isn't it still the same economy? And so you can look at the stock market crashes as opportunities, and you can allow them to just not scare you, not push you off of your investing principles and what you believe to be true about investing over time.